today's event, we are going to discuss four major things. That is our agenda. Initially, I'll start with introducing our firm and the services that we provide for the whole market, and what sort of sectors we are covering, and what sort of services you can benefit from us. After that, we'll touch base with property taxation, then planning how you should be looking forward within this property market and property portfolio, how you should be taking it further, and plan it in advance. I would always recommend, and I always say these to my clients, that it's best to plan it now before you do anything, because once you have done it, then it would be very difficult for us to do anything or alter anything. Once the ball is rolling, then it's hard to maneuver it. And then lastly, we will discuss about summary and other issues that are relevant to property again. And we would go in detail and discuss what you should be doing and what you should be expecting within your business and how you should be thinking it out of the box. Obviously, our best case scenario is we all want to save the tax, but be vigilant and follow the rules. With us, okay, we are ACCA, regulated by ACCA, Association of Certified Chartered Accountants. We are registered auditors as well. I am on the panel for UK auditors, and fully regulated by ACCA. Currently, we are based in Central London as our main office, and then we also have an office in Leeds as a branch office to provide different sort of services to cater the clients in Leeds specifically. Why us? We provide tailored services. We look at the business itself, because what we believe is every business is different. Even though maybe everyone is doing properties, 10 people are doing same business, but everyone has their own circumstances. Someone would have a different sort of income coming from maybe their employment, or someone would have an overseas income, or maybe an investment income, or a dividends, or something which is totally different to another person. So what we normally do is that we sit down with our client, we go through everything, we discuss their whole situation, and then based on that, we plan it. There is not a cookie cut option where you just tell the same story or same planning for everyone. Every single business is different from another one. So what we say is, or what we take pride of, is that we do spend quite a bit of time, focus on businesses, understand them, and provide them the services which are fully tailored for them. And specifically with the growth, what we have noticed is, starting with so many other businesses and so many businesses that are working on a different sectors. Some of them are on a property sector, some of them are probably retail or pharmacy or consultant or anything else. They start with a small pace and then they grow. So within this journey, we would always be with our client. We would advise them and we would help them grow their business, or look or forecast things in a way which would benefit them once they have touched that point. We would structure their business in a way that would help them save taxes. With taxes, HMRC has made set of rules. You might be earning same income, but if you show that as an employment income, you will be paying different tax. But if the same income you show it as a dividend income, you'll be paying different tax. So it's not that we are doing something wrong. The only thing is we need to choose which pocket we need to put our income in. And that always alter the taxes. We use advanced software integrations, utilize the technology as much as we can, and then utilize it for the best use for our clients and for ourselves. We have clients in Scotland as well. We have clients up north as well. All of those people do not come and see us on a monthly basis or on a quarterly basis when there is a bad return. They do not post us the records. We use these softwares so that we can interact with them on a monthly or a quarterly basis as and when needed. Avoid all of the old school methods, sending the records. No one brings us bag full of receipts or anything like that. Our portfolio is quite diversified. We have clients in retail sector, construction industries, doctors. We have also got clients which are overseas, in Australia, in Pakistan, India, Dubai. One of those companies also a listed company. So we do have a market and we do have quite diverse clients who are in different sort of sectors, and we are catering their needs. We not only provide the service of filing the tax returns, because you can do it yourself. HMRC has given the option to file the tax return yourself. You do not need an accountant to file the tax return only. If he has only got to look into the figure without the advice, just add it and submit it, you can do it yourself. It's best you save the money. What we do is we support them. We advise them. We explain them how the things need to be done. We also train them as we go along, and as they are growing, they would get a sort of training from us where they can understand that this is what is an allowable expense, or this is what I can't use my company debit card or credit card to use for the shopping or anything else. So our main agenda is to get the maximum benefit for the person without avoiding any taxes or evading any taxes, but we can do it in a specific way which would help our client in terms of taxes, and they would save quite a bit on overall income. We also help our clients in mortgage applications. So it's not that only we just prepare the accounts and that's it. For the mortgage applications, you need so much assistance from the accountants. We advise them. We also help them choosing the best rates for them. We calculate and forecast the figures for them on a 2-yearly basis or a 5-yearly basis, whichever would be beneficial for them, looking at their personal circumstances. So many of our clients who are into immigration, or probably they need some sort of assistance for their legal requirements, we are there to help them out. Sometimes they need letter confirmations, assistance. So all of that side of areas are also covered. Accountancy services, I have prepared the list of services that we normally provide for SMEs and large businesses. It's quite summarized one. For startup businesses, we help them with startup loan if they need. Incorporation and forecasting. Forecasting is sometimes you need it when you are applying for a loan and the company is a new company. If you have not traded for more than a year, then banks and any other lender, they are not confident on your figures. At that point, we come in, we provide the forecast, and then banks would also look into that. Is this firm a regulated firm, or is this someone just doing it without any regulation from ACCA or ICAW? They would not rely on the figures. So the edge is that because we are regulated by ACCA, our presence in central London as well, it gives us a bit of leverage with the lenders, and it helps getting the application approved quickly. Okay. Bookkeeping and payroll. This is, I think, pretty much all the accountants do it. It's a compliance, final accounts, VAT returns, management accounts. Sometimes when you go for a commercial loan, lenders have a requirement that on a quarterly basis, they need a management account. It's for the large incorporations anyways. But if that is required as you go, then we would be there to assist you on that. Tax investigation and forensics accounting, all of that we have dealt with. If someone needs it, the service is there. We also specialize on charities and not-for-profit organizations. This is something which is slightly different to normal accounting. All the accountants do not cater this services because it's different, slightly complicated. I wouldn't say too complicated, but it's different, I would say. And there are different tax rules, there are different presentations, there are different accounts, different regime, different compliances, and we help with all of them. We also help charities with writing their policies and assisting them on their policy side, because it's not HMRC who's going to come after charities. With charities, there is a charity commission separately to HMRC who comes and monitor them on a regular basis. Property and estates. With property and estates, which is more relevant to our agenda today, we help our clients grow in this market, assisting them only on the taxation side. Finding out the property, looking for the project. I think JDC and Project Possible is there to help you guys. We are not expert on that side. But how to acquire the property, what would be the best structure, and which option you should choose based on your personal circumstances, we would assist you. Once you bought the property, it's very hard to change it. So it's not, I would say you don't need an accountant once you have started the business and bought the property. I think you need an accountant or you need an advice before actually buying the property itself. Reason I'm saying, I'll give you an example. Let's say if you bought the property under your personal name and it's a buy to let property. If you later want to transfer it into a limited company, then you'll be paying stamp duty again, all over it again. So actually you are wasting your money. At that point, we might ask you not to transfer it because stamp duty might be so high that all of that money would go down the drain. So we might ask you, don't do it, take the hit, or we'll do the calculations probably on a 3 or 5 yearly basis, where we are going to look into the cost versus benefits. Estate planning is where, let's say, if you have built up the portfolio and we need to pass on to our next generation, everyone has to do it. I don't think so any one of us have a permit to live here forever. So we need to plan for it and do it in a way which is best suited for your next generation and most tax efficient way. So we look into inheritance tax, IHT, those sort of things. If the trust is needed, we look into that. So that planning is once you have got the portfolio, we would sit down with you, we look at your income, we look at the portfolio and advise you what's the next best step. We also have construction companies. I'm not sure if within this group people are into construction as well or not. Relevant to properties, but I would say it would be more relevant, let's say, if you have got a portfolio of 5 to 6 properties and then you do development, you do redecoration or any that sort of scenario, then it might be better off forming a different construction company. But this is, we are going to discuss on a later stage. Tax planning, we already discussed about inheritance tax. Trust setup is required only on the tax planning side. Again, depends and vary from person to person. Company structures, before you buy the property, we would recommend, let's talk about this. Audit, we do due diligence, statutory audit, independent examination for the charities, etc. I think this is not major agenda in today's. Come to property taxation. Okay, I've divided this into 4 stages. The reason I've done it is when you start the business, the first thing you do is you buy the property. When you are buying the property, at that point, you're looking into SDLT, stamp duty, land taxes. Now, stamp duty is, I've written the thresholds, up to 125,000, 0%, then 2%, 5%, 10 and 12. But here, anyone who is the first time buyer and the property is not buy to let, it's the main residence, then they get a tax, they get the bracket of £300,000. The first £300,000 would be at 0%. Next step is once you have bought the property, you are going to, fingers crossed, generate the profits and you are start getting income, etc., etc. Whatever the profit is, you're going to pay either income tax or a corporation tax. Income tax is on a self-employment, self-assessment basis, where you have got the property under your personal name, and any rental profit you're going to pay a tax as a sole trader. And corporation tax is when you've got the property under the company, and company is going to pay tax on the profits. Which one is better? Which option you should go for? Although it does matter that what are your circumstances, every person has their own different agenda and circumstances and different goals. Plus, they have got different finances. It's not a straightforward answer. I can say that once we have discussed it, then I can probably suggest that this would be the best option for you. We would discuss this in detail going forward. Capital gains tax is, let's say if you're selling the property after some period, you thought that there is a gain in it, let me sell the property and buy another property. At that point, you would look into CGT. HMRC would charge you 18% on a low rate bracket, which is 250, sorry. And if it's high rate bracket, it's 28%. Inheritance tax is when you pass the property to your next generation. If the person dies, then if there is a will, they'll follow the will. If there is no will, then the property would be transferred to the next in kin based on the rules and regulations. Every person is different. If wife is there, they'll transfer everything to the partner, etc. Tax on IHT is 40%. We'll discuss further. Everyone has 325,000 lifetime allowance on the IHT. But if it's the main residence, they get an extra £175,000 allowance. So £500,000 is per person. So if husband and wife, they're transferring to their children, they can get up to 1 million allowance. But there are different rules, regulations, circumstances. Again, we'll discuss. SDLT, first time buyer, no SDLT up to £300,000. And then going forward, for the first time buyers, then it's a 5% SDLT on portion from 300 to 500K. Additional rates on second property, if the property value is more than £400,000. Reason is, whenever you are going to buy a second property, even it's under your personal name, HMRC is going to charge you 3% extra surcharge on that property. Now that surcharge is payable even if you buy the first property on your limited company. So surcharge is only not payable on the properties under the value of 40K or if it's your main residence. But you also need to think out, like maybe someone has got the main residence. They want to sell their main house and buy another house where they are going to live. In that case, HMRC do give an exemption that if you're selling your main residence and buying another main residence, then you don't need to pay an extra 3% surcharge on SDLT. Overseas buyers from 1st of April 2021, they have introduced another extra surcharge of 2% on the top. Even if you're buying through a limited company, you won't be able to get away with it. Uh, this started from 1st of April 21. It's currently only in England and Northern Ireland. Scotland and Wales, you are safe at this point. I don't know when the rules would come up again, but this tax year, you are okay. Income tax. Income tax is on your personal rental income. It's nothing to do with the company. If you have bought the properties under your personal name, then you need to pay tax. Through self-assessment, you do that on a yearly basis. Last date to submit is 31st Jan. Normally, the tax year is from 6th of April to 5th of April. So let's say 5th of April 2022, the deadline would be 31st of January 2023. So they give you enough time to submit your self-assessment return. Simple accounts, take all the income, claim all the expenses, but there is one catch. With self-employment, if the property is under your personal name, interest on the mortgage, you cannot claim all of it. Now, anyone who is under the threshold at a low rate bracket, then they won't be affected because you are getting a relief for 20%. But if you are, let's say, on a high rate bracket, then this expense, you can only still claim 20% of it. Remaining 20% would be lost. This is one of the reasons that why we ask our clients to go on a limited company route rather than buying under your personal name. Because stamp duty is exactly the same. It's your second property. You are getting a rental income. It's not your main residence. And you are going to pay an extra 3% surcharge, even if you buy it under your personal name. And you're going to pay a 3% extra surcharge, even if you buy under a limited company. But with limited company, you can claim all the expenses. Mortgage interest. I have got some list of allowable expenses that are wholly and exclusively for letting only. Management fees, if there is a property agent who's charging you management fees, it's an allowable expense. Insurance on the property, which is on letting, you can again claim those expenses. Gardening, cleaning, painting and redecorating. If you are managing your property yourself, any mileage that you are traveling from your house to that property to maintain it is allowable. And first 10,000 is 45 pence, and then as you go down. Safety certificates like electricity safety, gas safety certificates. If it's a flat, it's not a house, then there would be some sort of service charge and ground rent. That is also allowable expense. Appliances, replacement and accountancy. Accountancy fee is straightforward, that is allowable. But appliances replacement. Now, what HMRC says is that it has to be like for like. Say, for instance, I think I did mention that example further probably. Let's say if you are replacing your washing machine and your previous washing machine has only got an option to wash, you cannot replace it with the higher end model, which has an option for washing and drying. So what they say is it has to be like for like to be able to claim it. Otherwise, they won't consider it as an expense, a revenue expense. I did classify it separately. Capital versus revenue. What HMRC says is there are two sort of expenses for the property business. One is capital expense, which you can get the benefit when you sell the property. Revenue expense is that expense that you can claim on a yearly basis. I put this picture here as a tax reducer. All of us want that to slash our tax out. But again, we have to be vigilant and follow the rules. Capital expenses are like building and structural expenses. Maybe you have got an extension to your property into the garden that you cannot claim as a revenue expense. So you cannot offset your profits for the year from that expense, whatever the cost is. Or sometimes people have converted their loft into a bedroom or a suite. that expense again cannot be claimed against your letting profit for the year. You can claim those expenses once you sold the property. So what we normally ask our client is, whenever you buy the property, always keep the completion statement from the solicitors, land registries with you, and any sort of capital expenses, keep the receipts. So tomorrow, if HMRC would like to challenge it, maybe you want to sell the property after 15 years. So I would still recommend make one folder, if not electronically, a physical folder where you keep the records. Because HMRC, whenever they are going to lose out on tax, they would like to inquire about it. So any capital expense that we are going to claim, we need to give them a proof that this is what I have done like 7 years ago, and that's why my gain has gone down. Could be very useful. So always recommended to keep the purchase completion statement when you are purchasing the property, and any capital sort of nature of expenses, keep the receipts. Electronic receipts are okay. Revenue expense, we discussed this slightly. It's same thing. It has to be replacement for like. Redecoration is okay. Repairs is okay. No improvement element. Here it is. So washing machine replaced by washer dryer is not acceptable. So you cannot improve the appliance. I mean, it has to be like for like. I was discussing this. No interest relief on high rate taxpayer. It's not completely a no interest, no relief. They give you 20% of it. So say for instance, if your mortgage interest is 5,000 pounds, if you deduct that from your profit, then you'll get a benefit of 40% if there was no restriction on this and you are at the high rate bracket. But if you are at the low rate bracket, then it doesn't matter because HMRC is still giving you 20% anyways. So for anyone whose income is, let's say, an approximate 50K, more than 50K, they are losing out 20% of their mortgage interest if the property is under their personal name. If it's under the limited company, then you don't need to worry about it. This is the major reason why we ask our clients to move into a limited company format rather than buying the property under your personal name. Tax losses, HMRC has got very strict rules on property losses. What they say is any loss that you have made on your property, you cannot offset that with your other income. So say for instance, if I've got an employment income of, let's say 30K, and I made a loss of 5K, I cannot reduce my employment income by that 5K. I can only utilize that with other profit from the property itself. It can be within the year. If you do not have any other profit within the year, you can carry it forward. Maybe next year you make a profit, you can offset the previous year losses. But the restriction is that it cannot be offset with your other income. Whereas the other income, the trading income, can be offset with any sort of profit. So if you're running a self-employment business as a sole trader and you're making a loss in your business, you can offset those losses with anything, even with the property profits. So slight restriction on the losses. Okay, this is a relief for those who are having a tenant in their main residence and they are also living in that property as well. HMRC says that if you have got one room, spare room, and you are getting a tenant into that room, as long as the total rent for the whole year is less than 7.5K, you don't need to pay any tax on it. But it has to be gross, not the profit. So you can't say that this is the rent, but I have paid for blah, 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 electricity, and then whatever is left, that's less than 7.5. It doesn't work like that. So it has to be the actual rent receivable that should be less than 7.5K. If there are more than one people who are getting the income from that property, then it's split. So say for instance, if you've got the main residence, husband and wife getting the income 50-50, then the threshold reduced by 50%. So it's 3750 each person. Overall, it's 7,500. If your income exceeds, let's say if you've got someone and you have given them a room, the main thing is you should be living in that property yourself. It should be your main residence. And if it has exceeded 7,500, then HMRC gives you two options. One option is prepare your tax returns and your accounts in a normal way, the way you are doing for other properties, or pay us the tax, anything that is above 7.5K. The option is up to us. We would look into which one is more beneficial. We do the calculations on both sides. We'll see which one is beneficial and we'll go for that one. Okay, capital gains tax is slightly different for properties. If it was a CGT on any other gain, they have a tax bracket, low rate is 10% and high rate is 20%. But only for the property itself, they have got slightly higher rate, which is 18% for the low rate. And for the high rate, it's 28%. So anyone who has a cap CGT, they sold the property, they have to pay the tax. It is quite expensive at 28%. This is one of the other reasons, based on your circumstances, it might be best for you to get the property under your company, because company will only pay 19% compared to 28%. Depends on the gain as well. Most of the gains, most of the properties, you are going to cross the threshold of 50K anyways. Exemptions. HMRC do have some sort of exemptions if it's your main residence. Now, at one point of time, any one person can only have one main residence. You cannot say that I have got a main residence in probably one of the properties, and second property is also my main residence because my parents are there and I go there and all my post is coming there. At one point of time, it has to be one. You have an option to choose one of them. Whichever you say that this is my main residence, for that period, that is your main residence, unless you move to another property. In some circumstances, you are living into one of the property, you have upgraded yourself, and what you want is you want to move into another property. And this, your previous property, you still want to keep it, but as a buy-to-let. Say, for instance, you spend 5 years in your main residence in property A, and then after probably 5 years, you go to another property, property B, and maybe another 10 years, you want to keep the property as a rental property, and after 15 years, you want to sell it. So whenever you are going to sell it, HMRC is going to apportion your capital gains on 5 years as a tax-free, and remaining 10 years would be taxed, because the other 10 years, some other property, which is property B, which is your main residence. So property A was probably on letting at that point. This is called principal private residence relief. The only relief is that it used to be 18 months, but now they have reduced it to 9 months. If you have lived in one of the properties and that had been your main residence, last 9 months of that period is deemed resident. So you will add that 5 years, 9 months as your main residence, and remaining 9 years, 3 months as probably on a letting, and then apportion it based on the percentage. Letting relief before 6th of April 2020, letting relief was available for all of them. But now they have put one clause and they have put the restriction on it. The restriction is that letting relief can only be available for those landlords who are also living in that property, and half of the property or probably part of the property is being let. Early days before April 20, if you are living in the property and then you have gone into another property and then you let the property for probably 5 years, 6 years, you are still not living in the property, the relief was available. But from 6th of April 2020, they have put a stop on it. It's very unlikely that this sort of situation comes up, but there are cases where landlords have a portion, give part of the portion of their main residence to the tenants. Maybe they are not utilizing the whole property, so it's best to have a tenant over there. Yeah. Then we come to non-resident landlords. Non-resident landlords, I was discussing with one of my clients probably a few weeks ago, where they had a landlord who is not a UK resident. So they have got a specific and different rules compared to those who are UK resident and living in the UK. Obviously, you do the test for tax residency status. And then let's say if you come up to the conclusion that person is a non-resident, then there are two things that you need to look into. First of all, the income tax. Who's going to declare the tax? First responsibility is for the estate agents. This is by law their responsibility to deduct 20% tax on source from the rental amount, pay to HMRC, and the remaining amount should be transferred to the landlord. Let's say if landlord is maintaining their property themselves, they do not have the estate agent, then responsibility comes to the tenant. Tenant should be aware of it, and they should pay 20% tax to HMRC and remaining 80% to the landlord. And I know I've seen some of the cases where tenants are not aware of it, but rules are there. And if you're getting caught, you would be responsible for it. Mainly what HMRC wants to do is they want to make sure that tax is being paid. This money is not going out of the country without paying any taxes, or they don't want to lose out on the taxation. If the annual rent is like £100 a week, then HMRC says don't worry about it. 5,200 a year rent can be paid gross to the landlord. Again, landlord himself can also apply for the exemptions. He can register with HMRC, tell them that, listen, I am paying all my taxes on time. I'm not going to run away with it. This is my registration, blah, 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 and their address, etc. Then HMRC gives them allowance option that, yes, you can give this confirmation to your tenant or estate agent that you are going to pay all the taxes. They don't need to charge you on source. The option is there if the landlord wants to use it. Bear in mind, we are only discussing non-resident landlords here. Then the last one is capital gains on disposal for any property that is in UK and the person is non-resident. HMRC does not want to wait for the next tax year to get the money from them. They want the property and the declaration to be done within 30 days of the sale. If the person is non-resident. Normally what happens is, let's say if you have sold a property between the period of 6th of April 21 to 5th of April 22, anytime. Maybe you have sold the property in May 2021. Your tax year finishes on 5th of April 22. You have time to file your taxes by 31st of January 2023. So you have got approximately more than 1.5 years to pay your taxes if you are UK resident. But with non-residents, what they want is that everything to be paid within 30 days. It needs to be declared to HMRC. Properties are part of your estate. There are other assets which would also be part of your estate. Everyone has their own things, which could include gold, cash, etc., etc. We normally look at the estate once any person who dies or away, or the income or the estate has to be transferred to the next generation. Then you calculate the value of the estate, taking out all the loan expenses, taking out any other costs, which could include funeral costs, etc. Whatever is left, then there is an exemption of lifetime limit of £325,000. After that, anything else would be charged at 40%. Let's say if you have got a property, it's a buy-to-let property, and this has been passed to your child, and maybe the value of the property is £500,000. After the limit, you got £175,000 left. You have to pay 40% of that 175. If, for instance, you do not have the money, HMRC is going to force you to sell the property and give them the IHT amount. They would not say, okay, leave it and pay us later when you sell the property, etc. So you need to be very careful and plan in advance, because it has happened with people when the estate was left and children did not have any option than to sell it, because they were unable to pay the taxes. And in that sort of situation, sometimes you do not find a good buyer as well, because if you're selling the property in rush, you won't get the rate that you're desiring for. HMRC has also introduced an extra limit of £175,000, but this is only for the main residence, because the property value is hiked up. And what HMRC says is we want to cover up to 1 million. So husband and wife, everyone has their own 325,000 bracket. Then if it's a main residence, they get another 175K, which makes it to $500,000 each. And altogether, it's 1 million. So if your main residence, husband and wife, they are transferring to their children, then they've got a tax-free bracket of 1 million. Other options, what you can do is you can form the trust, but it's not the solution. I cannot say that, don't worry about it, form the trust, put everything into the trust, and don't worry about pass it into the next generation, because trust has got so many changes recently, and you'll be charged too much. It depends on person to person. The moment you put your property into the trust, you'll be charged 20% straight away. Then every 6 years, there is a charge. So we look at the overall scenario. How many properties do you have? What is your portfolio? What other businesses you have? And based on that, we make the decision. Now, I would like to remind you that earlier on, I was telling you that there might be an option if you want to start a construction company of your own, if there is a big portfolio. Reason I'm saying this is any property companies are regarded as investment income. Investment income or investment companies have different tax rules when you are forming a trust. And trading companies, like a development company or a construction company, have different rules. You might be able to waive off the whole 20% if it's a trading company and you put that into the trust. But again, it's something which is very specific, and we can only discuss in detail with the persons looking into their finances and their portfolio and advice based on that. One more thing, let's say how to avoid it. What you say is, let me transfer the property, give it as a gift to my child now. Even if you give it to your child now, you would still be looking into IHT and CGT both. But what HMRC says is, yeah, that's fine. You have transferred the property, and if you die, this would not be part of your estate, but you have to live for next 7 years to be able to completely wipe it out. So let's say if I transfer my property today, and if I don't survive for next maybe 3 years or 5 years, then the exemption is not there fully. They've got different slabs for it. So first 3 years, if person transfers and dies within first 3 years, they would still be charged 40%. After that, they start reducing. So if someone dies between 3 to 4 year, third to fourth year is 32%. Instead of 40%, you're going to pay 32%. Fourth to fifth, and so on. And after seventh year, it's 0. So this is where you need to plan as you go along. That what is the best case scenario? How do you want to? You have built it up. You have got a good portfolio. You have got a tremendous growth. But what's next? You need to think about the next generation. You need to think how it would be passed on to your next in kin. Then this is where I have highlighted few of things in terms of mortgage interest. These are some of the planning sort of scenarios where I wanted to highlight that this is what you should be thinking when you are into the business. Mortgage interest, we discussed earlier. If you form a limited company and if you buy the property on the company, you can claim mortgage interest as an expense, and this is fully allowable as an expense. Most cases, when people go on buy to let, they would go on an interest only option. So any money that you are paying into the property, you can claim that as an expense, which would reduce your profit, and you'll not pay tax on that portion. With limited company, you also have an option for multiple directors and shareholders. How it benefits you in a limited company. Let's say, I'll give you both examples. So let's say if it's an individual who has bought the property, and whatever is their profit for the year, that's it. They need to pay tax on it. Even if they are at the high rate or a low rate, they still need to pay tax 20% or 40% regardless. But with limited company, you have got an option. Company only pay 19% corporation tax. Then you pay another 7.5% tax if you take the dividend out of the company into your personal account. But again, you don't need to take the whole money out of the company, because maybe you want to utilize that profit to buy another property, or maybe you want to do another business. In that case, you want to transfer that profit into another company, which is a trading company, and you give a loan to your associated company. So there is a way where you can avoid that 7.5% extra tax. It depends on your intention. What do you want to do with that money? That's where everyone has their own circumstances. Maybe you definitely need that money for some other reason, and then you'll be liable for 7.5% tax extra. Dividends is 7.5 at low rate, and high rate at for this tax year is 32.5%. So it's best to think about it don't take it out immediately. Plan it. And it's a huge difference. And if you look at the percentage, probably within 2 to 3 years, you can easily save money for your next property if you plan it well. There is no point of taking the money out, keeping in your personal account, if in the end you are going to utilize that money to buy another property anyways. So these are sort of things that I just want to give you points of ponder, where you can see that this could be beneficial. Taxable profits in a limited company is 19%. Again, if it's your personal or the property is under your personal name, then you might be paying 40%. But let's say if you are under the lower bracket and it's only one property, then you'll only be paying 20%. Then there is only 1% difference. It's not a major difference. This is where we ask our clients, what is their intention? What do they want to do? What is the next step? What is in their mind? And based on that, we will advise them, yeah, keep this under your name. we do not need to transfer it to the limited company because you do not have another income. And if you are going to transfer into limited company, you're going to end up paying an extra 3% surcharge on it. Investment through DLA. DLA is director's loan account. Let's say if you want to buy the property under your limited company, you need to pay the deposit. So first of all, you are going to transfer the money from your personal account into the limited company, give it a loan. So let's say I'm giving a loan to my own company and then buy the property from that deposit. Over the years, when you have built up the cash flow and you have grown the business, the amount of money that you have given the loan to your company, you can take it back tax-free. You're not going to be charged anything on it. The classic example, let's say value of the property is 100K. In most cases, you need to put 25% deposit on it. You put £25,000 from your personal account into the limited company, and then limited company paid for that deposit for that property. 4 years down the line, you want to take the money back, that £25,000, you do not pay any tax on it. So it's best to do it in that way rather than making it as share capital. Profits drawdown, we slightly discussed this earlier. It's best to plan. There is no point of taking all the money out if you don't need it. So anything which is less than 50,000 approximately, it's 7.5%. Anything which is higher than that is 32.5. So think about it. 3% extra stamp duty, but you are going to pay that 3% extra surcharge even if you buy the second property under your personal name. So I just want to highlight this, and so that you can see and absorb that these are the points where you need to think before you buy the property and what is your ultimate goal. Yeah, other issues. Okay, I have slightly touched it. I do not want to go into too detail because one, it's one of the sides which is very complicated and it cannot be explained in such a short period of session. And maybe most of you would not be looking into it, or it might not be relevant to you anyways. VAT on property income. Any income that is being generated from residential properties, it's outside the scope of the VAT. So even you would be thinking, let's say my income has gone more than £85,000. I need to register for VAT. It doesn't work like that. With residential properties, you do not need to worry about that, even if it goes more than 85K. Commercial, there is something else. Now with commercial properties, there are two sort of options. One is opt to tax or VAT opted, and the other one is you're not VAT opted. It does not matter what is your turnover. What matter is the property VAT opted or not? So it's slightly different than other trading businesses. With other trading businesses, you look at the turnover and you see that my business turnover has gone more than £85,000 in a year. I am bound to be registered for VAT. But here you have an option. Do you want to be opted or not? Sometimes when you buy the commercial property or a mixed use property as well, mixed use properties are those like probably the ground floor is a commercial property and then there are flats above that shop. You need to be very careful that is that property that you're buying is VAT opted or not. If the property is VAT opted, then any rent you are receiving from that property, you need to charge VAT from your tenants, regardless of whatever the total rent is. Even the rent is less than 85,000, you still need to charge VAT on that. So 85K threshold is not relevant here. Okay, these are other issues. So what I have done is I have highlighted these points so that you can think about that and see what is the best case scenario for you. Okay, transfer of equity shares. This is where I was talking to you about IHT. If you have got the property under the limited company, you might want to think about transferring some of the shares to your children. Obviously, age factor is there. You need to look into their age, etc., etc. But in most of the cases, our client do come back and say, listen, if I give this control to my child, he would be owner. He might go and sell the share or get a loan on that share, and I'll be stuck. And I don't know how he's going to use the money. This has happened so many times, but there is an option. So you can design class of shares. What that class of shares would do is, let's say you want to give away 50% of the property. But if you do it properly, you structure it, there is an option where you keep the 100% of the voting rights, but give away 50% of the benefits. So say, for instance, any dividends or any profit that you are going to receive, 50% is theirs, 50% is yours. But they cannot make a decision because you got the voting rights with yourself. And that would be probably either more than 50% or 100%. And distribution of profits is only your choice. I mean, if you don't want to declare a dividend, you don't want to transfer it to your child, the share, or you don't want to take it yourself, voting right is with you and you can restrict it. So this is one of the options on the limited company where you can plan it. Why I am saying start transferring to your next generation is because you also need to wait for next 7 years as well to be able to get it wiped out from IHT or from your estate. There is another option. Let's say if you have got a big portfolio, like 10, 12 properties, then you can form another management company, which is your company itself. Because you are managing all of those 10, 12 properties yourself, you can form your own management company. Now, why I'm saying that you form your own management company, because by the looks of it, what's the benefit? The benefit is trading and investment. The property company is your investment company. So different tax rules. But management company would be your trading company. So then you have totally different tax rules for the management. Some rules are similar, can't say totally different, but it is more beneficial. You can utilize more allowable expenses, and the profits from your property company can come to the management company. And then we can structure it and look into how we run it and how it best suits you. I have already spoken about construction company, and the same thing is here on the next point, where we are saying that you can form a development company separately rather than doing it under your investment company. This could benefit you. Again, the same concept as in the management company. One would be the trading company, the other one would be investment company. Now, there is another option. Let's say if you bought the property under your personal name and the property has been purchased between husband and wife. Now, by the looks of it, 50% is owned by husband and 50% is owned by a partner. And husband's income might be 55K or 60K, which means that any profit after a split 50-50, husband is going to pay 40% tax on it. Whereas the partner might have an income, or maybe she doesn't have an income, or sometimes they have an income which is under the 50K bracket, and they are only going to pay tax as a 20%. Here, you can also do a tax planning. You can form a trust deed, and you can say, again, you also need to look at the how the structure is there, and there are always pros and cons. We can discuss that. You can say that my wife is 80% owner of that, or my partner is 80% owner of that property, and 20% belongs to me. So instead of you paying 50% of the profit, or at a 40% bracket, you're only going to pay 20% of the profit at 40% rate, or maybe 90-10. It depends. Very useful tool, but you need to take the permission from HMRC. You need to submit some forms, and you also need to submit the trust deed prepared by one of the solicitors, which is not an expensive thing, but it does save quite a bit on taxes. Imagine if someone's profit is 15K, which is not a big amount. You pay 40% on 7,500, or you pay 40% on probably £1,000 or £2,000. So it does make a difference. Equity release, a very good option on the property. Let's say you got the property today for, I'll take a hypothetical figure of £125,000. After 2 years or 3 years, you remortgage the property. The value of that property has shifted from 125 to probably £175,000. Now you can extract that equity again, which is £50,000. The money you will receive, but you will never pay any tax on it because you have released the equity. You have not sold the property to pay the capital gains tax. You've just released the equity. You can use that money the way you want it. You can also buy another property or utilize in other businesses. It's up to you. Then IHT planning, we already discussed about this. This is if there is a limited company, then IHT planning is much easier compared to if the property is under the individuals. But everyone has their own circumstances and their own portfolio. If you do not have a big portfolio, then you might still be okay having those properties under your personal name. So it differs case by case.